How borrowing created modern capitalism. Hey everyone, and welcome back to the channel. Today, we're talking about something that's a huge part of our modern lives: credit and debt. Think about it: credit cards, student loans, mortgages, car payments. It feels like debt is just a normal part of life. But was it always this way? How did we get to a point where borrowing and lending are the engines of our entire global economy? Let's dive into the fascinating and sometimes surprising history of credit and debt. Believe it or not, the story of debt starts long before money was even invented. We're talking about 5,000 years ago in ancient Mesopotamia. In societies based on farming, you'd have good years and bad years. A farmer might have a terrible harvest and need seeds for the next season, so he'd go to his neighbor who had a surplus and say, "Hey, can I borrow some barley? I'll pay you back with interest after my next harvest." These weren't cash loans, they were loans of goods. And the records of these debts, inscribed on clay tablets, are some of the earliest forms of writing we've ever discovered. Debt literally helped invent writing. These early societies even had rules about it. The Code of Hammurabi, one of the oldest legal codes, had specific laws about interest rates and debt forgiveness to prevent people from falling into debt slavery. So, right from the beginning, societies recognized that while debt could be useful, it also had to be managed. As empires like Greece and Rome rose, so did the complexity of finance. They had actual currency now, which made lending way easier. Wealthy Romans, known as patricians, acted like early bankers, lending money to merchants for their long sea voyages or to politicians funding their campaigns. Interest was a big deal, and philosophers like Aristotle actually argued against it, saying it was unnatural for money to create more money. But the practical needs of trade and war meant lending was here to stay. Think of it like this: building a massive aqueduct or funding a legion required a huge amount of upfront capital that no single person had. Borrowing made these massive society-shaping projects possible. However, when the Roman Empire collapsed, much of this complex financial system crumbled with it. During the Middle Ages in Europe, things got tricky. The major religions, particularly Christianity and Islam, had strong prohibitions against usury, which is the practice of charging interest on loans. This was seen as taking advantage of someone's misfortune, but people still needed to borrow money. So, clever workarounds were developed. For example, a lender might buy a property from a borrower for a lump sum and then lease it back to them, with the lease payments acting as a form of hidden interest. It was during this time that certain groups, who were often excluded from other professions, became prominent moneylenders, creating complex social dynamics that lasted for centuries. In Italy, powerful merchant families like the Medici in Florence basically invented modern banking. They created systems of ledgers, bills of exchange, and international branches, financing everything from art to monarchies. They showed that by managing credit on a large scale, you could build immense wealth and power. The real game changer came during the age of exploration and the rise of global trade. Imagine you're a merchant in the 17th century wanting to send a ship to the Spice Islands. It's incredibly risky. The ship could sink, it could be attacked by pirates, or it could come back with nothing. The cost was enormous. This is where joint stock companies, like the Dutch East India Company, came in. Instead of one person taking all the risk, they sold shares to hundreds of investors. This was a form of credit. People were giving their money to the company with the expectation of a future profit. At the same time, the first national debts were born. Governments needed to fund massive armies and navies. Instead of just taxing their citizens into poverty, they started borrowing money by issuing bonds. People would buy these bonds, lending money to the government, and in return, they'd get regular interest payments. This created a stable, reliable way for governments to fund huge projects and gave people a safe way to invest their money. This system laid the foundation for modern capitalism. The Industrial Revolution in the 18th and 19th centuries put this system into overdrive. Building a factory, a railroad, or a steam engine required a massive amount of capital. Entrepreneurs and inventors didn't have that kind of cash lying around. They needed to borrow. Banks grew in size and importance, channeling the savings of ordinary people into these new industrial projects. This is where credit started to touch the lives of more and more people, not just the wealthy or merchants. Workers began saving money in banks, and small business owners could get loans to start their shops. But this era also saw the dark side of debt. Financial panics and crashes became more common when a lot of people defaulted on their loans at once. Banks could collapse, wiping out the savings of entire communities. This led to calls for more regulation and the creation of central banks to try and stabilize the economy. And that brings us to the 20th century and the world we know today. The invention of the automobile, the washing machine, the television, these were all expensive consumer goods. To get them into every home, companies had to figure out a way for people to buy them without having all the cash up front. This led to the rise of installment plans and consumer credit. Then, in the 1950s, the first general-purpose credit card, the Diners Club card, was introduced, followed by Bank AmeriCard, which would later become Visa. This was revolutionary. Suddenly, you had a tool that allowed you to borrow instantly for almost anything. The idea of personal debt shifted from being a sign of hardship to a tool for convenience and building a better life. This explosion of consumer credit fueled decades of economic growth, but it also created a culture where it's easy to live beyond our means. The 2008 financial crisis was a stark reminder of what can happen when debt, in this case mortgage debt, gets out of control on a massive scale. So, from clay tablets in Mesopotamia to the digital transactions on our phones, the story of credit and debt is really the story of human cooperation, ambition, and risk. It has enabled us to build empires, explore the world, and create technological wonders. But it has always been a double-edged sword, a powerful tool that needs to be handled with care and wisdom. Understanding its history helps us better navigate the complex financial world we live in today. Thanks so much for watching. What do you think is the biggest impact debt has had on our world? Let me know in the comments below. And if you enjoyed this journey through history, don't forget to like this video and subscribe for more content. See you next time.